One or two people have asked me to explain exactly what is meant by a couple of buzzwords used in the accounting profession in particular, but also that trip up investors regularly, and those are depreciation and amortisation. Depreciation and amortisation. So let's have those buzzwords up on screen. You'll find I make reference to them in some of my videos, and you'll come across these two phrases if you're an investor from time to time in relation to companies' financial statements. But what are they? Well, they're a bit of an accounting sort of fix, if you like. Basically, these describe the way in which accountants in particular try and deal with the cost of a firm's long-term assets. And those long-term assets are the ones that firms intend to keep, not immediately sell. So depreciation has something to do with long-term assets, broadly speaking, you can kick, like land, buildings, cars, machinery. Okay? Amortisation, in the UK at least, is used to describe a similar principle in relation to assets that you can't kick. So sort of licenses, software agreements, to some extent brands, that type of stuff. All right? So depreciation, amortisation. What's the objective? Well, for those people who are new to this stuff, accountants have their own way of looking at the world, which is why they're not a fabulous company always at dinner parties. Okay? And one of their little quirks is they worry about how a firm should deal with the cost of a long-term asset. For example, say a firm buys an asset for £1 million. All right, so pays £1 million for an asset. Big piece of plant or machinery, let's say. You might think, well, that's easy. You've just spent £1 million in cash. All right, well, you have. But accountants worry about something. They worry about how long that piece of plant machinery is going to last, and therefore what you should do about it in terms of the company's profits. Okay? Because what accountants believe is that you can't just write off £1 million against this year's profits and say, ta-da, job done. And the reason for that is this piece of plant machinery will presumably last 10 years. Now, 10 years is a bit of a judgment, all right? And accountants say, well, if you think the asset will last 10 years, what you should do is spread the cost of it across 10 years profit and loss accounts. So rather than dumping £1 million against profit now, what you ought to do is divide that 1 million by 10 years to come up with a 100,000, use K for short, cost charged against profit. So what's happening here is basically every year £100,000 is being charged against profits, called depreciation, all right, and that'll reduce profits by 100,000 every year, and the so-called carrying value of the asset in the balance sheet may start at 1 million, but it'll gradually decline as each £100,000 charge is incurred. Okay, so after 10 years, a full £1 million in total will have been charged against 10 separate profit and loss accounts. And when you apply that principle to an intangible asset, as they're called, same problem, same solution, but it's called amortisation. All right. Now, as an investor, this can present a slight problem. You know, what do you do about this very sort of fluffy cost that appears in the profit and loss account? Why do I say fluffy? Well, because although the cost of the asset should be fairly well known, there's presumably an invoice when the company bought it, 10 years is relatively subjective. Why 10? Why not 5? Why not 20? The answer is the company's directors sit down and determine how long they think each type of asset will last. So it's not even the case that all their assets will be assumed to last 10 years. Some will be assumed to last 5, some 10, some 20. Okay, so there's quite a bit of subjectivity in there. If I change the 10 years, I move the cost that's being charged each year. Okay? Here's another problem. The directors are allowed to assume the asset might be worth something when it's sold. I've sort of assumed that you buy it for 1 million, write off 100,000 over 10 years, and presumably at the end it's worth nothing, so you scrap it. But what if the directors estimate that the asset, and it will have to be an estimate because you're looking a long way into the future, the asset will be worth £200,000 at the end of its so-called useful life of 10 years? Well then, you're only going to charge the profit and loss account with the cost of using up the asset over that 10-year period. So suddenly your charge for depreciation becomes the 1 million cost less the bit you think you'll get back, which is 200,000, divided by 10 years. So suddenly you're looking at a cost of 800,000 over 10 years, or only £80,000. All right, and there's another subjective estimate. How long the asset will last is one, what it will be worth at the end of its useful life is another. All right, and this makes investors nervous because they think, well, hang on a minute, the directors are designing all these things, they're sort of guesstimates, and I want a kind of harder profit figure. I want to know the profit figure being reported is sort of as robust as possible. So what should I do? All right, well, opinions divided, and I'll just finish this video on how it's divided. There are people out there who believe, and by the way, I'm inclined to agree with them, that there should be some sort of recognition of the cost of using up an asset over its useful life charged against profits. All right, now I tend to agree with that point, but I come at it from another angle, which I'll mention right at the end. All right. However, there are other analysts who say, no, this is all too fluffy and there are too many judgments in here and I don't know what's going on, estimated lives, estimated residual values as they're called. This could be any number here, this 100,000 could be 80, could be 20, could be 200. So forget it. I don't want this in my profit figure. So there are some people who will back it out. And that's where you get a number which I talk about in another video called What is EBITDA? What is earnings before interest, tax, depreciation and amortisation? Do take a look at that other video if you're not sure about what I just said. Okay. Now to wrap up, I said actually I don't agree with the view that you just ignore the cost of using a fixed asset over its useful life, because it is a real cost of running a business. So what number do I prefer? Well, it's one that I label in another video, the number the directors don't want you to find. It's a number called free cash flow. All right, and that is basically looking not at profits but at the cash flow statement. Okay, and it's taking a view of a company's performance by looking at the operating cash flow minus a deduction for the ongoing capex required to generate those cash flows. All right, and if that seems a little bit speedy, do take a look at that other video that I just mentioned for more information. So there it is. Hopefully for those people who ask me, that clarifies a little bit what this depreciation and amortisation malarkey is all about and why some investors get nervous about it, and one or two things that you can do to try and defluff the picture that these two buzzwords can give you about a company's profits.